Welcome to INBrief, brought to you by the Inside Network. And my guest today is Simon Adler, Fund Manager, Equity Value at Schroders, joining us from the UK. Welcome, Simon.
Thank you for having me.
It's a pleasure. Simon, can you explain first up how the Schroder Global Recovery Fund is different to traditional value strategies?
Yeah, so good question, James. I think you can broadly, clients tell us there are three reasons really why it's different from most other strategies. The first is a steadfast commitment to value. And when we talk about value, we're talking about the cheapest 20% of the market, the kind of traditional definitions of value. And there's a very good reason why we do that. Let's imagine your two sets of grandparents won the lottery, same day, both of them won the lottery in 1926. One set of grandparents were modern and cool, and they put 10 grand into growth shares, continually rotated that into growth shares over the years. The other grandparents were a bit more traditional, and they put 10 grand into value shares, Today, grandparents' growth, their bucket would be worth $80 million, an incredible amount of money. Grandparents' value, theirs would be worth $780 million, almost 10 times as much. So we stick to value through thick and thin. We have never changed and we will never change. We're only going to look in the cheapest part of the market. We screen the market. It's the only place we look. And that means that's quite different from most other people, because very few people tie themselves to that mast. And it means that we know we're in the part of the market that should deliver the best long-term returns. We know there are periods where it's difficult. But it also, and very importantly, means our clients know that we are going to be value. We're not going to star drift. That's what we're going to be. So that's the first reason people say we're different. The second reason is our process. So Schroders launched their first recovery fund 50 years ago, 1970. Our team has got 150 years experience nearly at just looking at value shares. And that has led us to build a value process. A process geared specifically to avoiding value traps. So we build a 10-year model, 10 years through the P&L, cash flow, balance sheet notes, the accounts gone through line by line by line, year by year by year, in forensic detail. We then use that to answer what we call our 7 red questions. The 7 reasons why a share can look cheap on a screen, but not actually recover. So things like, what is the structural threat? Is the balance sheet good enough? Do the profits turn into cash? These questions are answered every single time in rigorous detail. And clients tell us that's another reason why we're different, because our process is only geared towards value. It's been refined and refined and refined to try and help us weed out value traps. The third reason people say we're different is our approach to trying to get better. Our absolute key ingredient of our team is to be the best value investors possible. And to do that, we need to get better and better and better. And we need to do that on the basis of evidence and data. So every share we've looked at since 2014 is saved in what we call our value archive, James. And that now has about 2,500 entries in it. The 10-year model, the 7 red questions, what we think the fair value is. And each year we pull out all the stocks we looked at 5 years before, so average holding period, and we say, what do we get right, what do we get wrong? We're good at this, bad at that, and so on and so on. And that means we can get better on the basis of data and evidence with a big enough sample size and have a systematic approach to being the best value investors we can be. So what makes us different, what our clients tell us, is that it's our commitment and steadfast commitment to value, the cheapest 20% of the market. It's our process that's geared towards avoiding value traps. And it's our desire to improve.
So are you deep value investors, Simon, going where other investors fear to tread?
I think that's probably the right way of describing it. We're going in places other people can't, won't, or don't know how to do, really. And it's because we're working for a firm that backs us as a team. That Schroders, as I said, have been doing value for so long. The firm backs us. We've got fantastic clients that back us. And that allows us to consistently stick to, as I said, the cheapest 20% of the market, which, we think that's just value. But as the definition of value has broadened, I think you're right that other people would call that deep value.
What are your key metrics?
So we screen the world on cyclically adjusted profits. So we look at the CAPE, cyclically adjusted PE, so price to 10-year average earnings per share, sometimes known as the Schiller PE. We look at that from a Schiller PE. We also look at enterprise value to 10-year average net operating profit after tax. So that includes debt and pension. and it includes, the cost of the capital part of the business, and it's after tax. So we're looking at a range of measures, but the ones we prefer are cyclically adjusted, so you don't get kind of tricked into where the profits are in the cycle.
And Simon, devil's advocate question: what do you say to people who'll tell you that the major growth stocks with their margins, if they wanted to stop reinvesting in their business, they could convert whatever they wanted to profit? And how do you value innovation, and how do you value the network effect? All of those kinds of arguments. What do you say to those?
Well, those arguments are very familiar to value investors, because broadly every generation something comes along which allows investors to say, this time it's different. So in the 70s, it was the Nifty 50. These are the only stocks that will give you growth. In the 80s, it was Japan. This is where all the growth is. In the 90s, it was the dot-com boom. In the 2000s, it was emerging markets. Every single time, there is a reason why this time it's different. And every single time, value bounces back, and it turns out it's a bubble. There is a kernel of truth to every bubble. There is an argument and a logic as to why these shares are worth more, and there is a kernel of truth today to the strength of the technological companies and the high quality businesses. But that has been blown out of all proportion. And the final thing I'd say is the technological changes throughout history are very significant. So I talked to you about the returns that value has delivered since 1926. Since then, we've had the popularization of the motor car, we've had air travel, we've had a world war, we've had a Cold War, we've had the rise of Japan, the rise of China, we've had emerging markets, we've had the invention of the internet, we've had dramatic changes in life expectancy. Everything that you can imagine is different. Those grandparents that won the lottery, bring them to today, would say the level of change that's happened, women entering the workforce, and being given the popular vote. It's remarkable the changes we've seen through the last 100 years, and yet value has outperformed through that period. Do we really believe that the changes today are that different from the ones I've just described? And if you do, are you already paying too high a price for it? So people are doubling up on bets that the history and evidence would suggest is getting dangerous.
Let's look at a really good example of a typical company held in the fund that sums up the precepts of the fund.
Yeah, so there's so many different companies. Perhaps if you allow me, I'll give you a few different examples, which will give you a broader idea. So for the purposes of these kind of conversations, we broadly split the stocks in the fund into kind of buckets, kind of areas of investment. So the first one we might call is turnarounds. About 30% of the portfolio is in turnarounds, companies that, for whatever reason, are trying to get from there to there. An example of that might be Royal Mail. Royal Mail is a company that is shifting from a postal business to a parcel business. Now, they've got an amazing asset, which is every single day of the week, or 6 days of the week, they deliver to every single household in the UK. Now, as post goes down and parcels come up, that allows them to transition their business and to turn around their business. At the same time, they've dramatically improved their relationships with both customers and employees, which are very important stakeholders for that business. So that's an example of a turnaround. It's been accelerated through COVID faster than we thought it might happen, but it's a simple turnaround. We've got about 30% of the portfolio in various different turnarounds. The next bucket one might want to talk about is unloved quality. These are companies that are high quality businesses, but they're covered in cloud today for whatever reason. We've got about 20% of the portfolio in them, and critically they are cheap. We're not paying more for them because they're quality. They have to be in that cheapest part of the market. But an example of that might be a company called HU Group. It used to be called Miraca, which is in Japan. They are the leading diagnostic testing company in Japan, but they overexpanded. They thought they were a bit good, frankly, and they expanded and expanded and expanded, and as a result, their margins have collapsed. They've now got new management team in there. They're building a world-class testing facility, and it will take a few years, but those clouds will fade, and what will come into view, the sun will shine on Japan's leading diagnostic testing business that we bought very cheaply. So there's about 20%, as I said, of the portfolio in what you might call unloved quality, good businesses that are in the clouds today. Another group might be the kind of value you might expect, banks and energy. We've got about 12, 13% in each of those. And we think they are very, very cheap. There is no doubt there are issues with banks and energy. Energy clearly has an ESG issue. The irony of the ESG issue is it has finally made the energy companies control their capital expenditure. It's finally made them control costs, and it's finally made them return capital to shareholders. So the irony is that actually the behavior of what they're doing now is both good for society and we think will be good for shareholders. So we've got those. And the last category that's probably worth talking about to give you that flavor is Japan. We think there's a lot of hidden value in Japan. Now, you have to turn over a lot of rocks to find those rubies in the rubble, but we think we found them. We've got about 14% of the portfolio in Japan today. And they're companies like DNA, which is a gaming business. Now, they've struggled to come up with new games for a while, but they, again, have changed their management team. They've got a new game called Slam Dunk. James, download it if you haven't already done so. Proving very popular in Asia. And what's interesting is they have this, but they also have a licensed and Nintendo branded games. And what that means is that they have a kind of funnel of popular things that someone else, Nintendo, have paid for to become popular, that they can make games out of. And as a result of that, there's two other really interesting things about DNA. One is that they have a big stake in Nintendo and they've got net cash. Together, that more or less covers the market cap of the business. And secondly, they are buying back shares like Billio. So by the end of this year, they'll have bought back 20% of their shares outstanding in the previous 2 years. So there are cheap stocks in Japan. There are stocks that also have good balance sheets and are shareholder friendly. You have to turn over a lot of rocks, but we think we found a handful. So that's not one company, but hopefully a kind of portfolio flavor of the kind of businesses we're invested in, a diverse range of really cheap companies that have different drivers to whether they will recover.
And Simon, how long do you have to wait on average, and what is the time frame at which you'd say this isn't going to work?
Yeah, so the average holding period's about 5 years, but that's an average. We've had some stocks we bought last spring that went and reached their fair value in 3 or 4 months, given the bounce back in share prices, and so we've sold them already. We've got other companies that have taken 7 or 8 years to turn around. So it varies, but in terms of where we've made a mistake, how do we recognize that? We have our very disciplined process. So if shares are doing badly, we will do a root and branch review. Each member of the team will go and rebuild their model, answer these 7 red questions, assess what they think the risk of permanently losing our clients' capital is, and what the reward is in the shares. And we will then say, are we still right? And have a debate. And what's interesting is to get into the portfolio, it has to be unanimous. Everyone has to agree. To get out of the portfolio, it just takes one person to say, I don't think this is the right stock now. We want a high bar to get in and a low bar to get out, because we want a conviction portfolio of cheap companies. And if we've made a mistake, we have to front up, take that on the chin, recycle the capital to somewhere better.
Simon, what do you think will be the biggest influence on equity market returns in, say, the next 5 years?
Well, it's a pretty standard answer as a value investor, which is that the strongest factor and the strongest force in investment on a 5-year view is valuation. So I think the biggest impact will be valuation. We've got the level of dispersion today between growth shares and value shares is as extreme or further than the dot-com boom on many measures. The dot-com boom, which has been regarded as almost a parody of stock markets, given how ridiculous it got. We're at or beyond that today. So I think that would be the biggest driver. I think there's a real chance of a big rotation away from the growth and the quality shares back to the fundamentally sound, cheap companies. And it's worth remembering what happened in the dot-com boom and what happened afterwards. 3 years on, the MSCI World Index was down 45%. And if people had invested more in technology, they'd probably lost half their money. Meanwhile, value was up. 5 years later, the MSCI World Index was still down versus the dot-com boom level, more than 10%, and value was up something like 200%. So this level of dispersion today is extreme. As you say, maybe this time it's different, but we believe it's very important for people to diversify and just have a bit of value, just in case 100 odd years of history is true, just in case that actually it's not different this time. So what we think it has the chance of being the biggest driver is that valuation dispersion coming back down to earth, which could be a pretty bad bump for technology and quality and could be quite exciting for value.
So where do you see the greatest opportunities over the near term, the next 12 months?
Oh, well, that is a dangerous question. More people have tripped up on that than banana skins, I always reckon. But gun to my head, I think the most interesting areas are probably the stocks that are perfectly good businesses that have been hit by COVID. So we've got some in the portfolio, and an example might be something like Genting, Singapore, which we own, which is a man-made island. They own a man-made island off Singapore called Sentosa. It's got one of Asia's largest casinos and a lot of tourist sites. Now, people will travel again. People will go on holiday again. There's a lot of pent-up demand. And so once COVID fades and travel becomes available, stocks like Genting Singapore will have its time in the sun again. Rolls-Royce we own as well. We bought it just after they announced and before they did the rights issue. They're paid on every hour an engine flies. That's clearly been a disaster for the last 12, 18 months, but people will fly again. And that business's profits and cash will grow. Or a different example, which we also own, is Molson Coors. It's the second biggest brewer in the US, and it's got a big pub business in Europe. Clearly, that's been a disaster. But people will go on holiday again, they will fly again, and they will go to the pub again. And those kinds of stocks, as the pandemic fades, it won't be gone in 12 months, clearly, but I think those kind of companies will have their time in the sun again.
That's all for INBrief. Simon Adler from Schroders, thank you very much for joining us from London.
Thank you, James.
It's been a pleasure.